Okay, so in this session, we'll be looking at establishing risk of material misstatement for tax purposes. So we are looking at audit risk and risk assessment. Now, first of all, we have to look at what we call a risk-based audit. So this is an audit approach that concentrates on what we call risk factors identified during the risk assessment or pre-audit research stage. So the approach is actually intended to ensure that greater attention is directed at the areas in which there's most likely to be a misstatement in the taxpayer's tax returns or financial statements. Now, when it comes to risk-based audit, there are some steps that are involved. So first of all, we have audit selection and we have audit planning. So within the audit selection, it involves audit strategies that are focusing on the taxpayer's non-compliance risks. So it identifies those taxpayers who are most likely to be non-compliant, that is, those who have the highest likelihood of yielding large amounts of audit adjustments and penalties. And it also focuses on compliance review tasks. After selection, it then moves to the planning stage. So the planning would mostly start with a written planning or a written plan containing one, an understanding of the taxpayer's business and environment, and two, a risk review, which will contain a list of prioritized risks, issues identified at the risk profiling stage, and a risk report. Then finally, it contains the audit approach, which is a sequence of activities to be followed or undertaken during the audit. Then the type of audit and the methodology and the techniques to be employed, typically known as the audit strategy. Then it also contains the personnel details, that is the audit team who will carry out the audit and a time management plan or a time budget. Then the expected duration or audit turnaround time. Then we have the management, which includes the direction and supervision, timing and briefing and review procedure, mostly known as the quality control area. Then we have resources. So special resources such as computer facilities, both hardware and software, special type stationery and other items not readily available are considered, and the appropriate authority to audit, such as endorsement or approval by a particular supervisor. Now, that is the approach taken in a risk-based audit, and you should be ready to deal with that in exam as it often appears. Now, what is audit risk? Now, an audit risk refers to any factor that can make the auditor give a wrong opinion or not let people trust the auditor's opinion. But in the case of a tax audit, it is the risk that the audit procedures or processes that the auditor uses will not identify the risk of material misstatement either in the form of underreporting or other irregularities in the taxpayer's records, and may make the auditor raise a wrong assessment on the taxpayer. So that is audit risk. The risk that the auditor will raise a wrong assessment either because of using the wrong procedures, using wrong samples, or any other reasons that are beyond the auditor's control. So that is what we call tax audit risk. Now, what are the elements of audit risk? There are three main elements of audit risk, which include inherent risk, control risk, and detection risk. Now, in other books, they know them as the type of risk, but for a tax audit, know them as the elements of audit risk. Why am I saying that? Because no matter the risk that appears to cause a material misstatement, it is caused by either one of these. Now, inherent risk and control risk are both known as risk of material misstatement. Now, if you get a case in the exam, sometimes you will not see them individually in the case, but they will come together. For instance, if a financial statement has, let's say, inventory recorded wrong, that means that it could be that it had poor controls. That is why the inventory was not recorded right. Or the nature or size of the business, maybe the business has a lot of branches, so it makes inventory recording very difficult. You see, but these things will not be shown on the financial statement. So you can just say inventory is, there's a risk that inventory is misstated as it is not meeting the requirements under the accounting standard. And this might be due to, or this might have been caused by, then you suggest some reasons. I get maybe poor controls, this and that. I get it. So, on the financial statements, we know inherent risk and control risk as risks of material misstatements. So we have three main elements: inherent risk, control risk, and detection risk. Now, what is inherent risk, which is part of risk of material misstatement? It is the risk of misstatement of an item due to its nature. I get it. So, for example, comparing inventory and cash, some inventories have higher inherent risk due to their valuation basis, as I was saying earlier. But then, due to the nature and size of your business, there are some things that are prevalent, or there are some risks particular to your business. Mostly inherent risks, mostly linked to business risks, but they have a financial statement implication. So something that is inherent in your business. So factors that can create inherent or influence inherent risk would be the integrity of directors and management, the management experience and the changes in management, industrial factors like competition, legislation, buying power of customers, exchange rates, all those things. Then the nature of your business, subject to technological changes, social factors, complexity of your underlying transactions. Let's say you have complex group structures, it makes some risk inherent in your business. So if there's susceptibility to loss or theft, and the quality of your accounting system. So that is it. Now, when it comes to control risk, this is the risk that your internal controls will not prevent or detect any material errors in the system. So this is a proof of the effectiveness or otherwise of the design and operation of your internal controls. Okay, so if the client controls that are set, or their internal accounting systems that are set, cannot detect and prevent fraud and error, then we say you have a control risk, or the controls are not so strong. Okay, now with regards to inherent risk as well, sometimes because of the nature and size of the business, it makes it improper to set some huge controls, or if the business is too big, it makes it difficult to set controls. So it can also be an inherent risk. Now, what are the factors that affect control risk? So there are 5 factors that actually affect control risk, and these are the elements of internal control systems. So we have the control environment, which talks about management attitude and awareness to controls. If management attitude and awareness of controls are very strict, it makes your control risk very low. And we have control procedures and activities, which are activities that they use to implement the internal control systems or to achieve the internal control objectives. Let's say authorization. Maybe if we authorize, we know that it will check theft of money and other things. So that is an example. Personnel controls, locking assets, locking cash in a vault, all those things are control activities. Then we have risk assessment procedures. So the entity being able to identify key risk in their system, evaluating the risk, assigning risk maps to them, managing the risk or bringing it to a minimal stage. Then the information system effectiveness. How effective is the information system in the organization? How do we move our accounting records? How does communication move from subordinates to superiors and vice versa? And the monitoring of controls, which is mostly done by internal audit. How effectively do we monitor our controls? So if these factors are very strong, it can lead to a decrease in the control risk in the organization. However, if they are poor, then internal control systems will have a lot of risks, or there will be high risk. Now, let's go to what we call detection risk. So detection risk is the risk that the auditor's substantive procedures and his review of the financial statement will actually not detect any material errors. So this is a proof of the effectiveness of the auditor's procedures. So this might be due to either the use of either the wrong samples, which we call a sampling risk, and the use of wrong procedures, which we call a procedures risk or non-sampling risk. So the auditor's failure to identify risk in the client system, okay, either because he's using wrong samples or he's using wrong procedures. But sometimes it is plain detection. For instance, if this is your first audit and the client has a third-party warehouse somewhere, unless you are being told, you wouldn't know. Okay, so that could also bring a detection risk. So most of the time when you get a question and they say this is your first audit, note that there are some things that would be hidden from you and you wouldn't know. Okay, so those are the elements of tax audit risk. Now, what are the types of risk in tax administration? So in tax administration, there are actually 2 types of audit risk to consider, which are the risk of inaccurate records and the risk of misapplication of tax laws. Now, you should know that I told you every kind of risk you see might have a bit of inherent and control risk embedded in them because they are risk of material misstatement. So let's first look at the risk of inaccurate records. So this is the risk that the taxpayer's records do not accurately reflect the facts. The risk of inaccurate records has to do with whether the activities of the taxpayer are properly stated in the records used to compute the taxes. So in other words, it is the risk that the records contain mistakes or omissions that affect the computation of the taxes. So the auditor must determine if the summary records are complete and accurate, and if he or she can rely on the summary records of the taxpayer. So for example, if the taxable sales were left out or understated, the tax reported based on the records would often be incorrect. So if you don't have proper records, then your taxes will not also be correct. Then we have the risk of misapplication of the tax law. This is the risk that the taxpayer did not apply the tax law correctly. So the risk of misapplication of the tax law deals with the taxpayer's understanding of the tax law and the application of the law to their various activities that they do. So the risk here is that the taxpayer incorrectly interpreted or failed to correctly apply the tax law and therefore misstated the taxes owed. So the auditor should thoroughly discuss with the taxpayer the procedures used in determining the tax base for the program being audited to evaluate this risk. And this is a major risk, as taxpayers know that the law is subject to interpretation and therefore they try to interpret the law in their own way or misapply the tax law. Now let's look at fraud and error, which is a separate type of risk but not included in the ones we just discussed. So this is the risk that the taxpayer, actively trying to defraud the state, tries to hide taxable transactions or ignore the tax law. He's trying to defraud the law or the tax authorities. So the key to distinguishing this risk from other risks is the taxpayer's intent. What is his intent? Is it trying to do this intentionally or unintentionally? If you do it intentionally, then it's fraud. If you do it unintentionally, then it's an error. So tax fraud is an active disregard of the tax law or active omission of transactions with the intent of evading taxes. So what are some of the activities that could indicate tax fraud? Yes, when you have the intent to evade taxes or escape taxes, when you give false explanation or misleading information to the tax authorities, when you impede tax legislation, when there are large discrepancies and concealment of your income, when you have numerous errors in your own favor, when you have fictitious records, false deductions, exemptions, or credits, when you fail to keep or furnish or file returns and records, when you have large and frequent cash dealings, you don't record any customers that you buy, you sell to, or suppliers that you buy from. Then when you have some fraudulent and Ponzi schemes, all those things indicate fraud. Now, when it comes to detection and prevention of fraud, what are the responsibilities of the auditor and the taxpayer? Now, when it comes to detection and prevention of fraud, the taxpayer's responsibility is that he has to detect and prevent fraud. So the taxpayers management and those charged with governance are primarily responsible for detection and prevention of fraud. So the taxpayer is responsible for establishing a strong system of internal control so that he can detect and prevent the fraud that occurs. Now, what is the auditor's responsibility? So you should also know that the auditor is not responsible for detecting and preventing fraud. However, the ISA 240, or the International Standard on Auditing, requires the auditor to be aware when planning and performing their audits that fraud may have taken place. So the auditor is only responsible for detecting fraud to the extent that it is material to the financial statement or tax returns. Yes. So if that fraud can impact my audit of the returns, then we shall consider it. So if the auditor discovers any fraud, his responsibility relating to the fraud of the audit prescribes that, one, he should communicate the discovered fraud to the taxpayer as soon as discovered or suspected. And if the discovered fraud involves management, then he must communicate to those charged with governance or the board of directors. So the auditor should also consider if he has a statutory duty to report the fraud to a regulatory and enforcement authority, such as the police and other bodies. And the auditor should also consider the effect of the fraud on the tax audit report. So that is fraud. How about error? I told you if error, it means it was done unintentionally. So error is an unintentional mistake. So the auditors have the following duties regarding detection and reporting of error. One, the auditor has the responsibility of discovering material errors that affect the financial statement. Two, the auditor should assess whether immaterial errors discovered during the audit are material in aggregate. when you put them together. And three, the records of all errors discovered by the auditor should be communicated to the management of the taxpayer as soon as possible. And four, the auditor should request the discovered errors to be corrected by management. And five, the aggregate of the uncorrected misstatements that were determined by management not to be material, both individually and in aggregate to the financial statements and tax returns, should be communicated to those charged with governance or the board of directors by the auditor. Now, let's look at some conditions which increase the risk of fraud and error. First of all, is the question of the integrity or competence of the management of the taxpayer. So you should know that there are some factors like if the management is dominated by one person or a small powerful group and there's no effective oversight board or committee, it could bring question to the integrity of the management. Also, sometimes there could be complex group structures where complexity does not seem to be warranted. Sometimes there's a continuing failure to correct major weaknesses in their internal control systems where the corrections can actually be done, but they will not do it. Where there's high turnover of key accounting and financial personnel, and sometimes there's some significant and prolonged understaffing of the accounting department so that they can steal money. Only few guys are there. And there are also frequent changes in legal counsel and their auditors, yes, because they are hiding something. Secondly, we could have unusual pressures within the entity. So the industry, some factors are like the industry is declining and the failures are increasing. There's inadequate working capital due to their declining profits or rapid expansions. The quality of their earnings are deteriorating. The entity needs a rising profit trend to support the market price of its shares due to a contemplated public offering, a takeover, or any other reason. And the entity can also have significant investment in an industry or product line noted for rapid change. And also, sometimes the entity is heavily dependent on one or few products or customers. And the pressure is exerted on accounting personnel to complete the financial statement in an unusually short period, which most accountants or most people in the industry experience most of the time. They'll be putting pressure on you at the appropriate time, they will not mind you. But when it's getting closer, then unnecessary pressure will be given. Then sometimes there could be unusual transactions, especially near the accounting year end, that have a significant effect on your transactions and your earnings, like transactions with related parties, payment for services that appear excessive in relation to the supplies and the services provided. Now, problems in obtaining sufficient appropriate audit evidence can also be one thing that can lead to fraud and error, or that have a take on fraud and error. So sometimes inaccurate records or inadequate records like incomplete files, excessive adjustment to books and accounts, and transactions that have not been recorded in the normal procedures. Then we also have things like inadequate documentation of transactions, such as the lack of proper authorization, supporting documents not available, and alteration to the various documents. Also, conflicting evidence and unexplainable changes in their operating ratios. And also, we could have things like unreasonable responses by management to the audit inquiry. So this is fraud and error, and you must be ready to deal with them, know the taxpayers' responsibilities, and also know the auditor's responsibilities. Now let's look at risk assessment and determination of response to assessed risks. Now, risk assessment and determination of response to assessed risks involves the following steps. So when you go and they ask you for risk assessment procedure or process, first of all, you must identify the tax risk, categorize the risk, profile the risk, analyze the risk, assess the risk, and respond to the risk. So, identifying the risk. So, from the perspective of the taxpayers, they always have a number of strategies that may be employed to avoid the payment of the right amount of taxes. So, this may include one, staying out of the system by not registering at all, not maintaining books or records, not submitting declarations on time, submitting incorrect declarations, not paying the correct amount of taxes, identifying risk areas that require tax auditors to exercise their professional judgment. So there are no hard and fast rules for the procedures that should be followed or how judgment should be exercised. So the auditor should rely on his or her own common sense in reviewing the background information and assessing where the tax risk actually exists. So there are two main tools that are used to identify potential risk issues. We can review the taxpayer's compliance history. We can also perform analytical procedure. And this may consist of return review for large and usual questionable items and financial ratio analysis. So first of all, what are some of the areas in the organization that could be subject to risk? So for example, when we take sales, the potential risk could be poor records, suppression of sales, misappropriation of sales revenue, and unbanked sales. Taking stocks, we could have things like short delivery, poor security, unauthorized sales. The caliber of staff that are used in the sales may, or the stock handling may be of high illiteracy. So there could most of the time be a difference between book stock and physical stock, and the use of way bills rather than invoices. There could also be non-existence of tally cards, frequent changes in stock valuation methods, and having a lot of warehouses. Then when it comes to assets, we may have obsolete equipment that could bring wastage, specialized equipment which cannot be sold. Then expenses, we could have falsification of account, unsubstantiated claims. And with documents, we could have photocopies, the fear of releasing documents, missing number of missing numbers in the invoice series. Then in the client system, we have an unusual number of records entered, missing or destroyed information, glib or guarded replies to audit enquiries. Then we have computer generated invoices, which is the computer can print out missing items by isolating gaps in series. Then other income, we have to look at disposal of fixed assets, scrap sales, and service income, which may have risks associated with them. Now, let's look at what we call revenue risk, another type of risk which we might look out for. So this is the occurrence of an activity which directly or indirectly reduces the potential or desired tax revenue result. Yes. So if it is going to reduce revenue to government, then it's a revenue risk. So this encompasses the failure to declare or pay the right amount of tax at the right time. So what are the factors that influence revenue risk? So we have things like non-arm's length transactions or transfer pricing manipulations, issues of non-compliance with the tax laws, aggressive attitude of the taxpayer to interpreting the tax laws, poor business record systems, discrepancies across the taxpayer's tax returns and tax files. And in accordance with the Revenue Administration Act, the taxpayer's revenue is said to be at risk if the following arise. So where the taxpayer becomes bankrupt or is wound up or goes into liquidation, and also if the Commissioner General believes on reasonable grounds that the taxpayer is about to leave the country indefinitely, is about to cease activity or business in the country, he has committed an offense under the tax law, and also where the Commissioner General considers it appropriate, including where the person fails to maintain adequate documentation and records. So, what are some of the tools that we use to measure revenue risk? So, we have intelligence gathering information from your own intelligence and from other parties, third party information received, ratio analysis and comparison analytical procedures, observation and profiling of the taxpayers industry, information analysis by also comparing financial to tax data and areas of law that are subject to tax exploitation. So that is the identification of taxpayer risks. Now, when you identify the risk, you have to categorize this into the taxpayer's risk. Now, if you go to the exam and they also ask you to list some taxpayers' risk or explain taxpayers' risk, there are four. So remember, the taxpayer actually has to register with authority, file his returns, declare his income and expenses, and pay the tax associated. Now, if there's a mistake or something goes wrong in any of these processes, it creates a risk. So categorization of the risk. This is the risk that the taxpayer takes one or two measures to avoid paying taxes or pay less amount of taxes to the GRA. So this risk can be grouped under four headings. They are registration risk, filing risk, payment risk, and declaration risk. So anytime you see audit risk in the exam, these are most of the risks that they are talking about. So what is registration risk? This is the risk that the tax received or the tax yield is reduced by one, those who should register but they are not, or this encompasses the informal economy and those taxpayers who use avoidance devices to remain unregistered. So this is that there is that those who fulfill the requirements to register refuse to do so, or wrong information about the taxpayer being held on the register. So where the taxpayer is not supposed to be registered, but he is registered. That could also be registration risk, and those that are on the register also have no entitlement to registration. So within this category, the range of taxpayers can be found ranging from carousel fraudsters and classic repayment frauds through to potentially compliant taxpayers who by act of error or omission have remained registered when entitlement ceases. So we also have what we call filing risk. This is the risk that the tax yield will be understated or reduced by taxpayers not filing their returns by the due date. Although this risk cannot be ignored during an audit, there are many other treatment options available to tax administration. And also we have payment risk. Payment risk is the risk that the tax yield will be reduced by non-payment of amounts due on tax returns and assessment. So payment risk and filing risk could be closely related, but it is important to analyze them separately since the treatment may vary. Yes, so failure to pay your taxes, underpaying, they are all payment risks. Then declaration risk is a risk that the tax yield will be affected where the amounts shown on the tax returns are incorrect by error or deliberate act. Remember, two things can be done intentionally or unintentionally. And I told you when it's done intentionally, it is fraud. Unintentionally, it is error. So traditionally, many tax administrators concentrated on this risk area with the intention of determining which cases should be selected for conducting an audit. So it is now being increasingly recognized that other treatment options are available to verify that the declaration made by taxpayers are correct and where error or fraud is discovered to allow for corrective actions to be taken. So under declaration and over declaration of income should be considered. Then let's look at the third stage. After you categorize the risk, you need to profile the risk. What is risk profiling? It is a systematic process of identifying and evaluating possible risk in tax administration that could affect the achievement of audit objectives. So, risk profiling actually has to do with identifying, evaluating, and assigning risk scores to them. That is how we actually do it. So, risk profiling should also involve a review of the internal systems within an organization to obtain a picture of any in-house factors that influence the non-attainment of audit objectives. So, it mostly involves the use of risk analysis techniques that help to examine taxpayer reported information, data from other agencies, tax administration intelligence, and publicly available information against what we call risk filters to identify potential compliance risk of the taxpayer. So, what are some of the tools we use in risk profiling? They are the same tools we use in analytical procedures like trend analysis, ratio analysis, common analytical review devices, statistical inferences, tax gap analysis, inquiries of the taxpayers' management and staff to identify and profile risk, and observation and inspection. Now, after this, you do a typical risk analysis, which involves a detailed analysis of the various risks based on the profile of the risk and the category of the risk. After that, we assess the risk. So, assessing the risk would mostly involve an overall review of the risk and looking at how it impacts the taxpayer's business. So, when you are responding to the assessed risks, you can increase your professional skepticism, you can add more staff, use more experienced staff, use experts, make audit procedures less predictable to those conducting the fraud, and the choice between substantive and control-based testing should also be looked at. Now, we can respond at an assertion level, okay, which may involve the nature of the audit testing that we may do. So, like detailed audit procedures that focuses on a particular risk area, seeking evidence from a more reliable source, or seeking corroborative evidence from an alternative source. Then the extent of the testing, we can take bigger samples, we can seek more corroborative evidence, and we can also consider 100% testing. Now, when it comes to the timing, responses could involve an interim audit and the continuous use of computer assisted audit techniques. So, this is the process for assessing tax audit risks. You should be prepared to deal with them when it appears.